Forward guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. We are smack in the middle of big bank earnings. Last week, JP Morgan, Bank of America, all the big banks reported, and banks continue to report. So, to break it all down, I'm so glad to be joined once again by Chris Whalen, veteran bank analyst of Whalen Global Advisors and the institutional risk analyst. Chris, great to see you again. What are the big themes for you as you've been probing the analyst calls? We all know, okay, so and so, they beat earnings. It wasn't as good as expectations. That doesn't really matter. The stock went up. Who cares? In terms of the big themes, I'm talking about credit. I'm talking about net interest margins. I'm talking about capital markets. What stands out to you?
Most banks have seen continued shrinkage in net interest margins. We've talked about this, but it's like Groundhog Day. You have the same earnings quarter after quarter, but people react differently. And so the street has been backing away from the large caps really since May, which is when, JP and the rest of them peaked. And what you've seen is that a smaller group, a higher performing group, is now leading the way. And it's kind of interesting, this evolution. But I think the managers are clearly anticipating that net interest margin, the other things you and I look at, are going to be flat, and credit is inching up. It's not going up fast. It's mostly commercial. But we just wrote a piece yesterday about Pinnacle Financial down in Nashville, and they just did a fairly significant house cleaning, sold a lot of low coupon bonds, took a pretty big loss, almost $1 billion for a $50 billion bank. And then they did a credit risk sharing transaction with a very well-known hedge fund on the street, and essentially put down their risk-weighted assets for capital purposes, for regulatory purposes. But I don't think they're really buying insurance. They have a pristine book. I don't think you're going to see a lot of defaults on this book, right? So bottom line, Jack, it costs you 12, 14% to window dress your balance sheet and free up a little cash internally. Because if you take the risk weight on the asset from 50%, $4 for every $100 worth of loans, right, down to say zero, because you have treasury collateral and you've raised a big pile of money, right? The money's sitting there, the Fed can see it, and they say, oh, good. If there are losses on the book, then the investor gets paid back less than par. It's very similar to the transactions Fannie Mae and Freddie Mac have done. And these are good with the Fed. If you follow the Fed's guidance on these transactions, then you don't even need to ask them. They'll just approve it as long as you check all the boxes. A lot of stuff going on in earnings, Jack, to answer your question. There's a lot of stuff going on behind the scenes with commercial real estate. There's some signature properties, for example, that are going to foreclosure now in New York City. And we got some every day, by the way, in commercial. There's a story on the headline at The Real Deal every day.
I know you are a big fan, as am I, of The Real Deal about
they're having such fun.
The real estate market, commercial real estate issues. So just to back up, Chris. So what you were talking about, I think it's synthetic risk transfers or credit risk transfers. That's high level, definitely not 101. I'll ask you about that, in
yeah.
20
well, the
minutes.
point is that they're dealing with the problem. You don't want the FDIC to have to take over the bank, right?
No.
And I don't want to suggest that with Pinnacle. Pinnacle's a well-run bank. And I use them as an example of people that are acting with purpose, who've done the math and say, yeah, I got to sell those Ginnie Mae 2s so I can go out and buy some Ginnie Mae 6s. Okay. That's the math. And big banks are not doing that. Bank of America is not doing that. And that worries me. Bank of America is losing money on the bank right now. The traders are keeping that thing alive. So
yeah, that is an interest rate thing. They bought a Ginnie Mae agency security, very, very low credit risk, basically no credit risk, with earning 2% when interest rates were at zero. And now interest rates are at 5.5%. So they're still earning low. And what you said, they're selling the two, so they have an immediate loss, but that improves their future capital. So they're basically taking the pain early. Would
they
you like?
Catch up within 3 years. And what it does is it raises the yield on their book 3%, Jack. 3 points. Just to give everybody a reference point, if you're a trader today or you're a lender and you have to warehouse assets or finance assets, it's costing you more than 6% today. So if you've got a Ginnie Mae paying you 2, you got a problem. The average yield on Brian Moynihan's book at Bank of America is less than 3. That does not work. So all of the big banks are still hoping the Fed is going to come to their rescue. But let's face it, how much is the Fed going to drop rates in the next few months, Jack? Point, right?
Mhm.
Is that going to really change things if you're sitting on a book with an average yield of, 3? No.
What did you make of Bank of America's earnings? You noted that the return on equity was 8%, and also that the actual bank, minus the investment banks, so doing capital markets and funding activities, the actual bank was losing money, the $2 trillion bank. That surprised me. And, Chris, I will offer probably a differing view of yours. I actually do like Brian Moynihan, the CEO, and when he's interviewed, I think he has an effective communication style. He only says the words that are
Well,
necessary.
everyone likes him, but that's why he got the job.
But yeah, I mean, I think his team bought a lot of low yielding securities with a very long duration, and that is haunting
Well,
the
it's
bank.
the MO of the bank going back decades. They have always kept their production. And when you didn't have a lot of volatility in interest rates, it was okay because the bank always typically had pretty low funding costs. They had a lot of business that just came in through the branches, and they were never really good at selling. They were not a production shop. So that's why they wanted to buy Countrywide. Even before Countrywide fell into their arms, they kind of wanted that shop because those guys knew how to sell loans and make
Mhm.
loans. And they also were a big primary dealer. Countrywide sold a lot of treasury bonds.
I didn't know that.
They had a sales culture, whereas Bank of America has always been like a Main Street bank that was retail funded and it made mortgage loans. And I mean, going back to the original Bank of Italy in California, okay? That's their ethic, that's their culture. And unfortunately, they took their eye off the ball because the duration swings in 2020, 21, 22 were just so big that they have swamped the bank. They should be doing risk sharing transactions every day, really. And if you look at Jamie Dimon, if you compare the two, Jamie Dimon has been managing the duration on his balance sheet extremely well.
Yes.
And they have moved with the market. That's what a bank has to do. So what should Brian have done? He should have sold those loans he made in 2021 for 104 and bought T-bills. That was the trade. And this goes with Silicon Valley Bank too. It's the same story. It's a duration story. Either you manage a duration or you don't. And I think BA has really done a bad job on that.
Yes, and the issues that have plagued the banking system over the past 2 years, which you and I have talked about, is almost entirely interest rate related.
Yes.
They bought securities that yielded too low and then interest rates went up. So contrary to what you were hearing on TV in 2021, those banks did not benefit from the interest rate shock.
No, and they weren't ready for it. When the Fed is telling you inflation is transitory, hold on, wait. That was a bit of a head fake, but the magnitude of the swing was just so dramatic. I mean, in my world, mortgages, we went from a 5 duration on Ginnies in 2019 down to a 1 by the end of 2020. And if you think of what that implies for price of a security, it fell by 20 plus points.
Mm-hmm.
So how does a bank manage that if they're not used to thinking about that? And if the entire regulatory world is about credit risk? That's what Basel is about. We've written a lot about that in the blog, and it's just history. I think, by the way, there's a very good chance that Trump's going to walk away from Basel once he gets into the White House. There's other things going on in the background we can talk about later, but that's a big change. I don't think the folks at the Fed are quite ready for that, nor is the industry. But the industry could sue and knock out Basel tomorrow.
And yeah, Basel is the global banking regulatory authority from the Bank for International.
Well, with the Supreme Court decision getting rid of the Chevron rule, any agency creation that's not backed by statute can be knocked out.
So, Chris, I think on the fundamentals, you have been bearish bank interest rate risk and relatively bullish credit risk. In other words, you think the interest rate risk in the banking system was severe and that net interest income would fall. I think you've been right about that.
It's been flat, Jack.
Yeah,
flat.
At least in the case of Bank of America, it fell. But yeah, flat overall. Thank you. And then on credit risk, you really have not been that concerned. I think you've been right about that. That credit card delinquencies were at
the consumer side, yes,
and now they're up to 150 basis. They're going up a little bit, but they're still below 2019 levels. How are you thinking about credit right now?
Depends who you look at. We just did a pre-earnings piece about the consumer lenders. The top of the heap is Synchrony,
Mhm.
which is basically the biggest white label credit card shop in the country. So they see changes in credit very early, and you're starting to see elevated defaults at that shop. On the other hand, though, if you look at consumer from JP Morgan and these other banks, it was flat to down. You even had them releasing reserves in some cases because, on 1 to 4 family homes, prices are still so strong that you don't see any default activity. If the obligor gets in trouble, they modify them a couple times, they fail, they sell the house and they give the family a check and off they go. So that's why, in the mortgage industry right now, strong home prices have made credit go away. The default rate for bank jumbos today is negative. That's extraordinary, but it's a reflection of prices.
Yes, on a collateralized loan, as the collateral increases in value, defaults tend to decrease because they're happy to lend against that
Well,
collateral. You
loan
saw
to
that with
value
cards.
ratios on these loans have been cut in half over the past 5 years. Think
Right.
about that.
Right. Of course,
So,
if the clock goes in reverse and housing prices fall, as they did in 2006, that obviously is an issue. But we are, nowhere close to
but
there.
listen, JP Morgan saw a big pop in their home equity portfolio. It's a very small portfolio now. It used to be 10% of their book. It's down below 2% now, which shows you what Jamie thinks about housing assets. But at the same time, this is a prime book. These are Jamie's customers, right? So there was a big uptick in defaults. I asked them to clarify what second quarter is going to be, but it's so small now, Jack, that it's not part of their GAAP disclosure. You got to wait for the bank call report. And of course, JP Morgan drops their call report on the last possible day. It is such a scandal the way the banks game the regulatory disclosure. As you know, I wait for it every quarter. So
Yes, you do. I read JP Morgan's earnings. I never encountered that and never would have because
no,
it's
the
not in
1 to
any
4s
GAAP.
were down. Defaults on their 1 to 4 book, which is big,
Yeah.
hundreds of billions of dollars, were down overall. So, I'm not suggesting there's some huge problem here, but you can see idiosyncratic changes in these portfolios at different banks. So we have Capital One next week. We have a whole raft of consumer lenders that are going to be coming out, Ally. So you want to look at all of them because they have different client bases, different default targets for their customer base, right? And you want to see how they do, especially the auto lenders and the unsecureds. SoFi is another one. You think of them for student loans, but really credit card, unsecured, consumer, mortgage are big pieces of their business now.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar-wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview.
Chris, I've got a question about SoFi. I've noticed and I've seen bulls on SoFi post on Twitter about how their net interest margin, which I explain for the audience, is the difference between what they make on loans and what they pay on deposits, is really wide because they have such low deposit costs. But I have a feeling that there's a reason they're so low. Why is their deposit cost so low?
I just think it's astute management on their part. They have, all of the firms that are trying to bank customers in different ways. In other words, they want to give them loans. They start off a relationship in many cases with a borrower who has a student loan. Then they try and give them a mortgage. Then they try and start doing asset management for them, investments, right? They haven't been too successful in that last piece yet. But, overall, they are taking advantage of their customer base, and that's really what determines their cost of funds. Schwab does the same thing.
Yeah,
but in the group right now, I would say SoFi is probably the lowest. The others are not. The one I worry about is Ally. Ally's cost of funds is quite high versus their book. See, what you do is you think, what do they pay for money and what's the yield on their book? You can get that from the Fed data that comes out for all these holding companies, by the way.
Yeah, I last year, I'm pretending that I know a lot about banks and digging. I had some concerns about Schwab just because their yield on securities were so low and the book was so massive.
Right.
You allayed my fears and you said, actually, their deposit franchise is very strong. I think on the fundamentals, you have been proven right about that. But as a result, the bank has shrunk, and the stock is going down because people don't like
the bank could go down to 50 or 100 billion. It doesn't matter. It really ultimately it comes up down to what kind of arb can they run on that bank, because they don't make a lot of loans. So most of the assets of that bank are going to be invested in securities. So
yes, and just for our audience, Chris, the business of when interest rates went to zero in 2020 and there's a huge flood of deposits, and then buying long duration securities that yield 2 or 3%, that's a loser's game. The smartest person in the world, the smartest banker in the world is going to lose doing that. And so that was Schwab's business.
Yeah. Well, especially with mortgage-backed securities, because they're so difficult to hedge.
Yes.
And the market was so distorted at that time that hedging was like a joke. So I think that, it's a dangerous world for banks when our central bank has to do what they did during COVID. That is even, I'm rewriting my book Inflated, by the way, this summer. And that period was one of the most radical periods in US history, even going back to the Depression and FDR's devaluation of the dollar, which was probably the other big one. But both of them were inflationary. They were using inflation to bail us out. Was it the right thing to do? Yeah, in the short term. But the problem is they don't stop. They just kept on going.
Yeah, they did.
It's like after 2008, once spreads in the bond market went back to normal, they should have stopped. That was the problem with QE1. Good idea, Ben. Big pat on the shoulder, right? But he should have stopped. But the politics were such that they didn't. And Bernanke is obviously left of center if you read his work. So,
right, he's independent now. He was a Republican, but
sort of, yeah. And nobody who works at the Fed could be a Republican. Let's just get that straight. I am a big fan of getting rid of the Board of Governors in Washington, because by having the Fed board in that city, it becomes corrupted. I'd like to add 3 reserve banks out west. We clearly need them, right? You could convert branches and, have a 12-person federal open market committee that's confirmed by the Senate. I think that's the answer.
How are you assessing the consumer risk of, so mortgages is fine, but of auto?
No, don't say fine, no, because from a credit perspective, yes, the assets are fine.
That's what I meant.
The consumer and what's happening to families, especially that low income quartile, no, bad. There's a lot of stress there. People are selling their homes because they can't afford to stay there. That's not a good sign.
Why?
Inflation, insurance, property taxes, all of the above, right? If the value of your home goes up by 100%, what happens to your property taxes?
It's true.
We've just seen that cycle here in New York. Insurance, the servicers have been kind of talking about this for the past year, because the insurance costs in places like Florida have doubled or trebled. The homeowner has to pay it, and then all of this cash sits in escrow for 9 months and before they pay the insurance. So there is a sunny side here. The banks are making a lot of money on this.
Because if you get a giant pile of money for 8 months, you can earn interest on that 5.5%.
Yeah, the escrow payments on property taxes and insurance in the United States have increased dramatically over the last 5 years. You don't hear JP Morgan complaining about that, by the way.
Very interesting. I hadn't thought about that. But Chris, the fact is, obviously, things can change in a year or two. And on the interest rate side, it's still screwy. But mortgage delinquencies and defaults remain exceptionally low now. So
yeah, even FHA came down this quarter. It's still close to 10%, which reflects the population. But, it should be in mid-teens. The reason it's not is because a lot of the COVID era policies, what we call waterfalls for dealing with default, basically tell the industry to modify the borrower until they can. So you can usually modify a delinquent borrower twice or 3 times. And then at that point, you get them to sell the house, and they keep the money. They keep the difference.
And it's probably regulation passed during or after the great financial crisis, because you don't want a cascade of foreclosures that,
Yes, and the industry totally agreed with that. But it was really the FHFA and HUD who put in place standards during the emergency using their emergency powers. And then the industry and HUD and the rest of them said, well, look, we'll just make it permanent. And that's essentially, and the CFPB too. They have a rule out right now to change standards for mortgage servicers. That's very important, but it's basically making permanent exactly what you were talking about, all the COVID period stuff.
Right, and the CFPB, the Consumer Financial Protection Bureau, started by Elizabeth Warren, and I and our audience know just how much you love her and her policies, but we'll skip on to that.
I love Elizabeth. She's a smart girl, but she says things that she knows are not right for political purposes, and that troubles me a bit. But everyone does this now, so
that is true. Okay, so in terms of consumer credit cards and auto loans,
next year. They're going to continue to creep up. I'm very interested to see Capital One next Wednesday, but ultimately it's still muted because there's still so much money sloshing around, number one. And number two, we just haven't seen the correction yet. I think the correction in housing prices and consumer credits a couple of years out.
Yes. Okay.
Even if the Fed cuts rates, even if we get a point from Powell between now and whenever he leaves, right? Because again, remember, my traders are paying 6+ for financing for loans. Do we want to buy a municipal bond with a 3% coupon? No.
Yeah.
So that's a break on the economy. Everybody in finance today has this break because the cost of funds is too high. Now, are they using the right inflation number? I don't think so. Most consumers would say inflation's a lot higher than 3%, right? And that's what I worry about is the wear and tear on consumers from COVID, especially that bottom quartile in terms of income in households. That is going to surface, Jack, very definitely.
Right. And even in the higher end, we saw American Express report today.
Yeah.
Their consumers, they're spending 6% more than they did last year for the second quarter, which is a lot. The rate of growth is really slowing down.
Guys.
That's
one of the best performing banks in the country.
Yeah.
And I'm so sad Discover is getting bought because they're typically one or two.
Mm-hmm. They're going to be bought by Capital One.
Yes. It's a funny story because Capital One, believe it or not, doesn't have their own rails. Rails are the platform you use for payments and credit cards. So Capital One's a bank, but they had never built their own payments platform. Jamie Dimon tried to buy Discover to keep it away from Capital One. So now that Capital One is buying Discover, the brand is good. It's small. They haven't been able to really grow the cards, but they have this cool payments platform, which they're going to merge on the Capital One. And I think that's going to be a big help. Capital One's costs are higher because they're in McLean, Virginia. Discover is up in the Upper Peninsula with the beavers and the forest products, and their costs are 25% less. So I hope that Capital One can merge what they need from that transaction and also continue to work on their expense side, though. There are many other examples of it. SoFi, all of them had to make the decision to invest in the tech that lets you do real-time payments in and out. That's one of the reasons it's so hard for people to compete in second lien mortgages, because it's set up like a revolver. It just happens to be secured on your house. So you can go to the ATM machine anytime you want and take cash out, but only a bank can really do that. So the payments platform is very important. That's why US Bank is such an interesting play. Still below $1 trillion in assets, but has a vast payments platform. Citi, that's their most valuable asset. If you could sell Citi to Google tomorrow, and that's why I keep saying Goldman ought to go have lunch with, David Solomon needs to have lunch with Jane Fraser. Very definitely. Let Jane do the bank. The institutional guys at Citi know secured lending. They're very good at it. And, let David go do deals. Be an amazing organization, $3 trillion in assets,
That would be too big to fail.
No, but Goldman needs deposits. They can't be competitive in institutional finance, making loans on mortgages and mortgage servicing rights and things like that if they're competing with Jamie.
Why should they do that, Chris? That's like, that's like you starting to write a newsletter about the railroads. It's not your expertise. Your expertise is banks.
No, but they're good at deals. Let them go do deals.
Yeah.
Capital markets. Yes. Citi's capital markets is weak. They've lost a lot of people. So you put the two together, I think it's an interesting trade.
So the consumer, we talked about that. Tell me about commercial real estate, which is a tail risk, but I just really have not appreciated how slow it is. I mean, I remember
Oh,
in the fall of 2020, there were
mhm,
bears talking about commercial real estate risk, and we're close to 4 years later, and
mhm.
this train is still on the tracks.
That's the nature of the beast. Commercial real estate is a professional market. It's a market where a lender can extend terms if they want to. Often they'll ask the borrower to put cash in if they're extending terms. But it's episodic, and it's in the interest of all the parties to drag their feet. So, for example, there are only now some assets that were financed by Signature Bank that are coming up for foreclosure. And it's mostly because of the borrowers. But the point is that changes in behavior, COVID, just the need on the part of many organizations to cut costs and downsize if they can, has made getting rid of commercial office space almost stylish. If you're not cutting back on office space and you're a CEO, there's something wrong with you. So this has had a big impact. Not everything is bad. There are a lot of new developments out there. Look at the results for Bank of the Ozarks, by the way. Once again,
One
they're
of your
doing
favorites,
just
yeah.
yeah. But they're in construction. They're in the front the front of the life cycle of a new asset, which is a really good place to be. When you're financing a mortgage, where you're financing an existing property that may now have to compete with a new property,
Yeah.
Florida, Texas, right? The entire southeast, southwest of the U.S. That's where it gets interesting. So this is going to go on for years. I don't think I'm borrowing some of the wisdom from my friend Stan Middleman. I have a bio of him coming out in September, which I urge people to read. If you want to know about mortgages, you want to listen to Stan because he understands. And basically, he's expecting the big reset in 28. We'll run out of buyers for homes. We may see some supply coming in, which would be helpful. And in commercial, like you say, it's going to drip, drip, drip. Every quarter, you're going to see defaults. You're going to see banks having to take losses, but they're idiosyncratic. It's not like residential housing or credit cards. You can't generalize about it the same way.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course, the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today, and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10, stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan VanEck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode.
Yes, and commercial real estate includes many things. And by the way, for our audience, not just financed by banks, I'm sure are a big
Private
player in that
REITs.
market too.
And by the way, multifamily has
Yeah.
mushroomed. So while residential is quiet, defaults in multifamily properties, many of which have been kind of on life support for the past several years or had gone to interest only on their loans, those are all starting to bubble up now because the cash.
Let's talk about that. So yeah, commercial real estate includes many things. It's lending to anything that's not a house, lending to hospitals, apartment
That's right.
buildings, offices. Offices, I think, has been the most troubled sector. Warehouses, offices, because of the whole work from home phenomenon. But so far, multifamily real estate had performed very well because we have a rental crisis, we have a housing crisis in this country, and if shelter is going up, rents are going up 11% year over year. Surprise, surprise. The banks are not going to be that lend against that.
Yeah, but we made those people, there was no one helping landlords during COVID. The progressives just assume that property developers are all wealthy and that they have this little pot of money hidden somewhere that they can use to subsidize, consumers who can't pay their rent or can't pay their mortgage. What the Fed did helped with that to some degree on the mortgage side,
because
but it also drove prices up dramatically, right? So now we have an affordability crisis in this country. You don't get any free lunch. And we have a lot of developers out there who owned these multifamily apartment buildings who are basically strapped. They don't have any reserves left, and they're dealing with rent control. Even Biden was talking about federal rent control legislation, and the progressives just don't get it because and many of them here in New York, they just don't care. They will do whatever they can to pander to consumers, even if it leaves the housing stock in places like New York City deteriorating, which is what's happening. If you're building high-end condos, you got no problem. But if you're building housing for the average person to live in at a reasonable cost, no, that's not happening.
Tell me, what did the defaults, delinquencies, and modifications look like in the multifamily commercial real estate part, which is a very large sector of the commercial real estate?
Well, it's about a $500 billion book for U.S. banks. The portion of it that's funded by REITs and other vehicles is larger. So figure the totality of it's closer to $1 trillion. Bank multifamily right now, we're seeing 100% losses when there's a default. So it means the entire loan, which was probably 50% of the original value of the building, is getting written down. So the
building is not worth as much as people thought.
Yeah, 50 cents on the dollar is a good place to start if you're in a jurisdiction like New York that has rent control. Because, rent control says, I can't recover my costs on the building. This is the insanity of Albany. And since the Republicans have been kind of driven out of New York politics, only the crazy people are involved in policy. We saw this with the de Blasio administration in New York City. So, if you're a developer, you're in a world of politics and corruption that is just dramatic.
Yeah. And so the rent control in New York City, that seems a little bit idiosyncratic. I'm sure there are other districts that have
California,
but in terms
San
of
Francisco,
across the country, are you experiencing defaults that are actually from the weakness in the underlying asset rather than idiosyncratic things like rent control or just rising interest rates hurt the profits of the developers?
It depends. You can have a situation where, the developer, the owner went out and had to refinance at a higher rate than they wanted to, and it doesn't work. If you're in a rent control area and you can't raise rents to keep up with your costs, then that's a problem. Because what happens is your lender, everybody follows the building. Everyone has access to the tax records. They can figure out the rent roll of the building. So if you have all of those pieces, you can figure out what the building's worth. Okay. Now, when you're talking to a bank, they only want to lend you 50 cents on the dollar on the building. So if the mortgage comes due and the value of the building has fallen, then the owner, quote unquote, has to put more equity in to keep it at 50 cents. That's the problem. So if you're in a building where you're losing money, let's say it's got some commercial and some residential in it, the commercial's empty. Okay. So you're really just getting paid by your residential customers and whatever else is left. This is a very typical story. The bank looks at it and they say, the value of the building's fallen. You have to put cash in. And remember, Jack, this was an asset class that for the past 75 years, mostly you would refinance every 7 years and take cash out.
Tax-free, right?
Yeah, it was a source of cash for many developers. That's why it was so popular. It was self-financing, essentially. And the banks loved it because the equity in the building went up. The loan to value ratios would fall during the loan. So it was very easy to refinance, right? We have the opposite situation now. That's really what's going on in multifamily.
What do you make about New York Community Bank, which really struggled because a lot of its loans were against rent-controlled properties, and last year they had they had a capital injection from a private equity consortium led by the former Treasury Secretary Mnuchin, as well as Hudson Bay Capital, a few other investors. I see they did a reverse stock split, which in general is always a sign of distress. Oftentimes,
it's bad. It doesn't work. I think they need more capital to turn the bank around. They have the Flagstar business, the servicing business. They had to sell the warehouse business to JP Morgan, which was a shame. But I just don't know how you make that work unless asset prices start going up, as we were just discussing, right? From a credit perspective, imagine you were thinking about buying that bank, Jack. You like the Flagstar piece. You got that. You got the consumer side of the bank. That's easy, right? But when you look at the multifamily book, what do you do with that? How do you assign a value to it? And I think that's the difficulty they face right now.
And you said signature loans, which were loans from the former Signature Bank, which went under also in 2023, I believe the same day as Silicon, or actually, no, over the weekend, a few days after Silicon Valley Bank. Are those loans still hung loans? They still can't find a home?
Well, some of them, a whole slug of the rent stabilized assets are still owned by the FDIC. And I imagine when Trump is in office and he is putting new people on the board, they're going to sell those assets and it will become a problem for New York State. I don't know, other than just hard money investors, if you can find buyers for those assets. You may not be able to get a mortgage on them, is what I'm saying. So New York State may have to come in and buy them, and then they'll just get added to the stock of rent-controlled city-owned properties. You know, New York runs 400,000 rental properties. So they've already got a big piece of that. That goes back to Robert Moses.
That's a real throwback. And Chris, you at Whalen Global Advisors, you have a basket of banks that you like for a variety of reasons. That
Yes.
I'll ask you why. That bank has been outperforming the KBWB, which is, I believe, regional banks. Or no, that's just all banks. Invesco Bank ETF. What is it about those banks that you like, and why do you think they've been outperforming in that environment?
What we did with the index was I started off with the basic methodology that KBW had defined for banks, and I looked at it. And what they do is they pick a representative book of large banks, so good and bad. They have JP Morgan, they have Bank of America, et cetera. Now, they're an investment banking shop, so it's hard for them to say to a large bank, well, you can't be in the index because your performance is not so good. What I did instead was I test our banks on 5 factors. One of them is size, but the rest of them are kind of classical measures like equity returns, efficiency, that sort of thing, just to let some of the better performers get into the game. Because, for example, American Express, you would be surprised to know that that bank does not get into most passive baskets. And it's just wrong. So by weighting our group based on performance and the score really from our 5 factors, we're able to showcase some of the better performers. You know, FCNB down in Charlotte, the guys who bought Silicon Valley Bank, right? Very, very well-run institution. Of course, Discover. Discover has typically been one of the better performers. Synchrony has been one of the better performers. But you don't see these in KBW because they're too small. And what's really fascinating, Jack, is that since May, when the large caps peaked, it's these banks have been leading the way. Customers in Pennsylvania, Jake Sidhu's bank, he's very astute CEO. So, you know, there are some smaller banks in these groups that I think are worthy of attention for investors. But the issue, of course, is liquidity because they're much smaller.
Yes, and large cap banks, JP Morgan and the like, they have been doing well just because they were coming from such a low level, the panic of last year.
Yes.
But
well, the managers wanted to buy them.
Right.
You know, when you have so many passive strategies out there, they will buy the KBW. Although, look, KBW is very small. It's only a couple $2 billion fund. So it doesn't really represent the industry that well. That fund ought to be 5 times that size.
And any ETF you look at or any basket of regional banks, smaller banks have really been outperforming since May when the big banks halted their advance. What advice would you have to someone who's been long a basket of regional banks or a smaller bank? I shouldn't say regional bank, a smaller bank. And in other words, what is motivating their outperformance as a basket right now? Because they probably have lower capital, maybe higher deposit, maybe higher percentage of commercial real estate. They, as a basket, they are different than the globally systemically important banks.
Well, they are, but I think what you find with these good performers, another one is Axos, which is, got attacked by the guys at Hindenburg, and they were accused of all sorts of things, but they have very low credit losses, extremely well managed bank, and again, they end up in that top 25 group consistently in our index. So what I would say to people is this: I personally got out of Wells and US Bank about 2 months ago because they had run okay. And I realized, though, that we were going to have some pretty difficult quarters going forward with flat NIM on the one hand, right?
That is smart, yep.
Yeah, and rising credit costs. So I thought, time to get out. I kept my preferreds. But what I would say is that you can own these top performers that are in our index. The subscribers to our premium service can see the entire index and the weighting. I think if you stick with the quality, you're going to be okay. But remember, banks are cyclical.
Mhm.
Banks follow the economy. So if we get into a recession next year or the year after, banks will certainly suffer when credit cost goes up. I have a great chart I often use with our clients, pre-tax income on the one hand and provisions for credit losses on the other. These are the two key relationships in banking, and that determines what's left for the shareholders.
Let's talk about capital markets. Has that been strong? I think that in terms of investment grade bonds and high yield bonds, there's been $1 trillion worth of issuance so far this year.
Goldman did very well across the board. That's their strength. I was happy to see that. Their credit, it's about where it was. Again, I think credit is not their strong hand, but overall it was good. Bank of America, Morgan Stanley, all of them saw very good results of capital markets and trading, which is what you would expect. I think a lot of issuers realized that we may be near the top in terms of rates. So you've seen a lot of floating rate issuance. CMOs have been very popular. But what's interesting is that the spread between mortgage securities and treasuries has been quite wide, and it has remained so. The banks have not been big buyers of mortgage paper at these levels, even though the yields are quite attractive. And I think part of that is that they feel like, if rates fall, if I pay 103 or 102 for that security today, they may prepay 50% next year after, and I'm going to get my money back at par. So that's not a good trade.
Right. What do you make of private credit, which is in a golden age? And I'll just explain for our audience: a bank makes loans by just printing money from nothing, and customers have the deposit and they have the loan. Private credit is institutional investors get together into a pooled fund and then loan that money out. So the money already exists. So it is different. And as big banks have stepped away from lending, perhaps for like regulatory reasons and other reasons, which you can share, there's been an opportunity for private creditors to make 12%, 13%, making loans to companies that banks used to lend to but are no longer. So how can you explain this dichotomy? And for example, Brian Moynihan, CEO of Bank of America, he said we are a huge lender to the middle market and also small and medium-sized businesses. How is it that private credit is making so much money making loans, and Bank of America, why isn't Bank of America doing these loans? And Bank of America has tons of money. They have $500 billion worth of securities.
It goes back to the traditional problem that Bank of America has had, which is that they're not great bankers. They are Main Street bankers who gather deposits, make mortgage loans, but anything much more complicated than that, they kind of get into trouble. And I think they have made a decision really since 2008 to de-risk the bank. So for example, they got entirely out of buying residential mortgage loans, even after they bought Countrywide. That was a remarkable change. Wells is leaving the market too, by the way. So, they could be doing those higher spread mortgage, commercial loans. But what I would tell you is that's more of the business of a Goldman Sachs or Fortress or any number of other firms, funds in some cases. These are all non-banks. They're mostly working with cash that they raise from customers, right? And then they'll supplement the leverage, with credit that they can get from a Goldman or a JP Morgan or whatever. But they're not as, competitive as the guys at JP, because JP's got half the cost of funds or less. Morgan Stanley, they don't take a lot of credit risk at Morgan Stanley. They're very low cost of funds because of their banks. They have two banks there that have 400 billion plus in total assets and big deposit bases. Not as good as what we were talking about before with SoFi in terms of the rate, but pretty good, and it provides stability to the organization. But remember, mostly Goldman, Morgan Stanley, 90% of what's going on there is in the broker-dealer, very large broker-dealer.
And how do you explain this miraculous makes it sound like it's a good thing. I'm not saying it's good or bad, but this a spectacular rise of private credit assets. We can put a chart up.
There's problems and there's excess liquidity. So the two come together. I think what's really funny is to see retail offers in private credit, which are in many cases just barely double digits. I don't know if a lot of those are going to work out very well.
Chris,
You know,
I was
credit
at a
ultimate-
conference, and some people who are bullish on private credit said that they want to have a private credit ETF.
God bless them. I'll stick with banks. I think that credit is something you can only do if you're involved with the asset. All right. You have to be in that business to just jump in as a jack of all trades and start trading credit. There are some firms that do that. Rhythm is one, Fortress. There's a whole bunch of them. Apollo is one of the leaders in this space, and they're good at it. They have really smart people working for them, but there is a lot of risk there. And what they do is these firms, BlackRock, all of them, they go out and raise client money. They manage that money in a credit fund. Well, you got to make sure that you make money on the credit, because if you don't buy it right, then you can be in a lot of trouble. You know, when people lend on commercial real estate now outside of the bank market, the higher risk lenders, what they're really asking themselves, Jack, when they underwrite the credit is, do I want to own this asset? If so-and-so defaults, I'm going to own the asset. Am I willing to do that at this price, right? That's
Right.
what commercial real estate underwriting is all about, because you may end up owning the building.
Right. And if you're a lender to a company that's very speculative, if the company goes under, you may have a plan to get warrants, or your debt becomes the new equity, so you become an investor. So that's part of some speculative directive lending,
Yeah.
or they don't call it speculative, it's opportunistic. But
there's a really cool service on Bloomberg that shows you all of the LBO deals, the private lenders, and now many of these deals are being worked out in private credit. So it's quite funny. These are all friends and neighbors. Let's put it that way.
Yes, and what you mean by that is so much of private credit, and particularly direct lending, is to finance private equity-backed companies, and often private equity companies do private credit, and they're used to also pay investors. So where are you on the spectrum of thinking, oh, private equity is great, they've had historically great internal rate of return, and I expect that to continue, and over here is it's a legal Ponzi scheme, and the private equity, private credit bubble will collapse? Where are you on that spectrum?
I don't think you can generalize about it. I think there are some people in private credit who really know what they're doing. The transaction we just wrote about with Pinnacle Financial, those are some very smart people who were involved in that.
Fund? Is that public?
No, I'm not going to mention them by
okay.
name, but I know the transaction because it was in the bank's disclosure, and I understood what they were saying. It's kind of a geeky paragraph, but if you understand what was going on there, they sold a bunch of stuff they didn't want anymore, the 2% coupons, right? And then they did a swap with a large hedge fund that's specialized in credit for many years. And what they basically did was lower the risk weighting on their mortgage book from 50% down to 0. And what that does internally is it frees up cash that the bank can now reinvest at a higher yield. So you're going to see smarter banks doing these trades. Jamie Dimon obviously has done one on residential and one on commercial loans. And it's a nice way of managing your book. I think it's a good thing, but I think you got to look at it on a case-by-case basis, because there may be some banks that are already gone, and it would be better for the FDIC to just come in and resolve them. So we're going to see that too, by the way. You will see more bank failures.
Why?
Because, the bank has only so much cash. Remember, they're levered at 15-1. So when they start taking losses on commercial loans, 40, 50% of the original loan amount, that gets painful really fast. And unless the bank has really good asset returns, good equity returns, so they have the income to just clean up the mess and keep going, then they get in trouble and the bank's got to be sold. That's it. It's a highly levered business, banking. It's not like, the hard money guys who will lend you money for your beach house down in Florida, they deal with cash.
Yeah.
They tend to avoid leverage.
Same with private credit.
Look at Old Man Hovanian and some of the old school developers who built the malls all around the country. They never, ever use leverage until they're ready to break ground and build. And they had, lease agreements from their anchor tenants. You know what I mean? Because otherwise the leverage would destroy you.
Mm-hmm. And earlier you referenced, Chris, a report from Hindenburg Research, a short seller, which I would say what I consider an objective opinion, one of the best performing activist short sellers. So writing a short report about companies and that have issues, and then it turns out the company does have issues and the stock price falls sharply. So when you're disagreeing with this guy, you are fighting a very strong participant. So I'm interested.
Well, I know something about banks, Jack.
Yeah, you do. You do.
Look, as a banker and a longtime member of FINRA, if you make statements about a publicly listed company and you say that they're a fraud and that they're, dealing with bad people in New York City, yada, yada, okay, fine. But remember, that bank submitted those financials under the pain of perjury. So unless you can really prove your point with some numbers, not just vague generalizations about borrowers, but unless you can say, listen, this charge-off number that they submitted to the Fed is wrong, and the numbers they have submitted to the SEC are wrong, okay? That's what I need to hear from these guys, and then I'll start taking them seriously.
So their report is Axis Bank, glaring commercial real estate loans problems and lax underwriting beneath this price for perfection bank. What did they get wrong specifically?
I'm just saying, if you are going to tell me that the bank's disclosure is wrong, you got to be more specific. Okay? If you're telling me that loan valuations and loss rates are a fiction, then you better have a little more than they've got in their report. I read their report. I always give everybody a shot, Jack.
Yeah.
But ultimately, I live with, what is filed in the public domain. I never talk to bank management. There's no point. Under Reg FD, everything they can tell me is in their disclosure, right?
Yeah.
So why bother? Investor relations people are just there for retail investors to hold their hands and serve them drinks.
Yeah, well, it is, I'd say, Battle of the Titans. One of the best performing activist short seller versus Chris Whalen, banking expert. You sound like an unstoppable force. It's an immovable object.
Look, they're in my index. If I decide that they have lied to me, I take them out of the index.
Yeah. After
New York Community Bank's little restatement in the first quarter, we added a new provision to our criteria for the index that I worked on with the guys at Thematic, by the way. They're great. And I said, if you restate, you're out. Boom, goodbye. And I think you have to do that because we use public financials in the test. So if you tell me I can no longer rely on those financials anymore, then you're out. Sorry.
And Chris, tell us about the Basel III Endgame, which has been proposed, but it's being the complaints it's being rewritten, which it increased bank regulation, probably higher capital requirements. What is your view on it? How would it impact large banks, as well as, how do you think if, as he's winning the polls, President Trump gets reelected, that changes things?
Well, we wrote a piece about this in the blog last week, which I urge your viewers to take a look at. Why? When I was a kid, and we lived on Macomb Street in Washington, D.C., my father, Richard Whalen, was a big guy in politics, and he wrote speeches for Ronald Reagan and was very involved in that city for decades. He comes home one day while we're eating dinner in like the mid-'70s and starts bothering us about the Basel Agreement and about Herstatt Bank, which had just failed, right? So from those events in the mid-'70s, Paul Volcker, a lot of people in the Bank of England, the Bank for International Settlements in Switzerland, start this thing called Basel, the Basel Accord. And there were various ministerial level agreements that we now treat as Basel, the Basel framework, but they have no standing in US law. And the Basel Accord itself, which is really a treaty, was never submitted to the Senate for ratification. So in essence, everything that the Fed has done since that time, they did on their own without any real statutory authority. But remember, this is in a foreign country. So we're essentially taking our cues on US banks from the Basel folks in Switzerland. My point is that in the wake of the Supreme Court decision knocking out the Chevron doctrine, really anything that a federal agency does that is not the result of specific instructions from Congress, like Humphrey Hawkins, for example, is subject to challenge. And if Jamie Dimon wanted to sue the Fed tomorrow and question just where Basel is coming from, he could do it, and he would have a very good chance of winning. So I think all the regulators are going to have to pause, Jack, and they're going to have to think to themselves, gee, what does that Supreme Court decision mean for what we've been working on, like the Basel III Endgame proposal? I have a feeling that Powell's going to leave if Trump is elected. And if that occurs, I think Basel III Endgame is going to be put on hold. The vice presidential candidate's already called for it to be removed. There's letters from dozens of members of Congress in both parties indicating displeasure. And I think there's a chance that Trump will just go his own way. He won't even cooperate with the other Basel countries. It's basically the group of 10.
You said bipartisans, Republicans and Democrats have expressed their displeasure. Expressed with the entire thing, or expressed their displeasure with the first version, which is now being changed, and there's going to be a second draft coming out, right?
We'll have to see.
Yeah.
If they have to repropose this rule, and if they don't change the more offensive parts of it with regards to the housing sector, it'll get killed, no question. I don't think it has a ghost chance, no matter what they do to it in the House with the House Republicans. And if you have the vice president of the United States leading the charge against it, I think the Fed is going to end up having the fold. But what we could have, Jack, for a little while is just chaos. Because, if we don't have Basel, what do? We have to basically go back to Reg Y and the old bank regulations and tune them up for today's needs, which I think is very easily done, by the way. But the whole structure, Washington, the lawyers, everybody else, the banks, are so focused on Basel in that process that I don't think they're ready to see the whole thing disrupted. But I think that's very possible, given the Supreme Court.
And so the Supreme Court ruling, Chevron's saying that regulatory authorities have to basically have Congress. So obviously, the Federal Reserve was created by an act of Congress, but specifically in the Federal Reserve Act, is there, so in addition to having monetary policy, they are also a major bank regulator. Is that bank regulation function written into Congress, or is that kind of something they just...
There are general authorities in the act for the Fed to, example, set standards for member banks, okay? And there's the Bank Holding Company Act, which also has a lot of provisions in it to give the Fed authority. But the trouble is that when the Fed starts interpreting these statutes and building out regulations, that's when they get into trouble, because the real message from Chief Justice Roberts is that lawyers interpret the law, not regulatory agencies. So a big example of this that you're definitely going to see a lot of fireworks over, the Consumer Protection Agency of Elizabeth Warren. I have a feeling that the Trump people are going to lobotomize that agency, and you will definitely see the Republicans in the House challenging the funding by the Fed. I think it's very likely that the agency will be turned into another federal agency with a bipartisan board and the whole bit. It'll look like the SEC.
And if there is no Basel III, or bank regulations are increasingly relaxed under President Trump's second term, let's try and avoid. That would be a good thing. That would be a bad thing. It sounds like you're more on the side of some of these regulations and capital ratios are unnecessary and they stifle banking. The Democrat, I heard it, when Powell testified before the House or the Senate, a Democrat made the case of if there's banks make bad loans, the shareholders should pay, not the depositors. And that makes sense too. There's arguments on both sides, but just being objective and sticking to what will actually happen. Will that mean banks will have lower capital ratios and they will be able to lend more and make more money with more risk? But would that be an environment in which bank stocks rally like crazy?
No, I think we'll stay where we are in terms of regulation, capital, and all that. You may not see a revision. So we could end up living with Basel as it is today. I don't think the banks are particularly restrained or constrained by current regulation. They certainly would like to have more loans to make. There's a problem right now with demand for credit. But I think, overall, many industries, not just banking, but the mortgage industry, everyone's hoping is that the regulators are going to take less of our time. The amount of time and money that financial institutions have to spend dealing with regulatory inquiries is just it's silly. We don't need to have a system that is punitive and that goes out every day trying to find reasons to find somebody or hit them with an enforcement action. But unfortunately, under Joe Biden, that's been the politics. They have politicized many agencies in Washington, unfortunately. And I'm hoping we could get back to something a little more rational, and that'll help banks, Jack. No question. You asked Jamie Dimon that question, he'll probably keep you on the phone for an hour. He talks about this all the time in his shareholder letter.
Yes, I would love to talk to Jamie Dimon on the phone for an hour. All right, so Chris, as we promised at the beginning, you talked about a very complex transaction, synthetic risk transfers or credit risk transfers where banks are basically selling credit risk to non-banks in order to clean house and improve their economic reality, take less credit risks, spread the risk around, or just do some window dressing and make their capital ratios better for regulators, either one or both. And I actually learned about this market when I did an interview last December, I believe, with Eagle Credit Corp, which is one of the largest CLO equity investors in the world, and they actually have been doing some of these deals. And it does sound a lot like what happened in 2006 and 2007, where you just are able to sell credit risk easily, and then it's borne by people who don't fully understand it and the like. And then AIG is on the hook for trillions of dollars in losses.
It's different this time. And why?
Right. So sorry. But the guy I interviewed, the CEO, he said actually that the loans are very good quality and it mainly is for a regulatory arbitrage. So just explain your view on this matter, and you, by all means, please reference the Pinnacle transaction, which you highlighted in your piece.
Yeah, well, let's take two examples. Example one is a bank that, like you say, doesn't particularly have asset quality problems, but they do need to reposition. They do need to earn more money. So they would like to move cash internally from low yielding assets to higher yielding assets. So they will go out, do a synthetic risk transfer, and effectively they're paying an investor in order to put a big pile of cash aside. The Fed requires this. They want to see the money, to your point, right? So put the cash there. They pay the investor 8% a year, let's say. And the cash is invested in treasury bills. So in addition to the 8% you're paying the investor directly, they make another 3 or 4 on the yield on the collateral. So it's a low double-digit trade. What is the bank getting for this? Capital arbitrage. Okay? So that's example one. Is it good or bad? You have to compare the cost of this transaction with raising equity. That's how you answer the question. If this transaction is cheaper, and if it helps the bank short-term get to where they need to go, and I think Pinnacle is a good example of this. It's right in their earnings disclosure for everybody to read. Then that's good. Now, second example is a bank that has a gnarly multifamily book, okay, where they're taking losses on the book. In that case, you're probably going to end up paying the investor 10 or even 15% or more, so that you actually have the ability to hit them with losses. And what you're going to do is you're going to take a pool of loans that are troubled. You're going to say to them, look, I'm going to pay you 15% plus the carry on the collateral. So it's almost 20%. But you're going to absorb the first 2 points of loss on this book. And I do anticipate losses. You see, you price this against credit default swaps. You price this against other reference points to figure out if it works. But, if you look at the risk transfer transactions of Fannie Mae and Freddie Mac, which are very similar to this in a sense that they raise the cash, and then if at the end of the transaction there are losses, they subtract the losses from the cash and they give the investor back the rest. So that's how these work. And the Fed is good with these. They don't mind these types of transactions. They don't want to see banks relying on a specific counterparty without having the cash held by somebody else, right? That's the bottom line with the Fed.
So the second transaction is a multifamily loan, a commercial real estate loan against an apartment building that's having credit risk issues. Right. I get it. The first thing you said is they have a Ginnie Mae security earning too little money, 2%, 3%. So the issue is not credit risk, it's interest rate risk. Why would you need to have a synthetic risk transfer? Why couldn't you just sell the 2% Ginnie and earn the 6%?
These are two different things. See, Pinnacle announced these two transactions together. Selling the low coupon paper was one transaction. They took the proceeds. They also had a forward sale agreement that they reversed. And so they took all of that net money after they took the losses and they reinvested it at a higher rate. And the result's going to be a 300 basis point increase in the yield for the bank, which is great. That's a wonderful trade. The second piece is this synthetic risk transfer trade, where they are taking loans that they're holding on their book and they're essentially lowering the risk weight on those loans from 50%, $4 for every $100 worth of loans in capital, right, down to say zero. Well, all of a sudden, they now have lower risk-weighted assets, their capital is higher, and they can redeploy cash internally into other activities, again, with higher yields. So there's two pieces to this in the Pinnacle example.
So you may argue that this is nowhere close to what was being done in 2006 and 7, either in the scale or in the level of credit risk. But Chris, would you understand someone who say this does makes me uncomfortable because it is regulatory arbitrage, and that was done prior to the great financial crisis, where you put the risky stuff into off-balance sheet items or structured investment vehicles, and basically you're taking more risk than capital ratios would allow you to.
No, you see, in the intervening years, not only did we have the risk transfer transactions from Fannie and Freddie as an example, but the Fed and the FDIC and the other regulators thought about this. They have discussed it and issued guidance on this. So the type of risk transfers that you're seeing today with banks are pretty, I would say, above board and transparent. That doesn't mean there's not other stuff going on, which is bad. And I totally take your point on that, Jack. But from the Fed's perspective, if we can help the bank turn around and reorient themselves, that's better than taking them over. So it's all a matter of degree. Number one is raise capital. Number two is do a risk-sharing transaction. And number three is we take over the bank and pay out depositors. Number three is bad because, frankly, until rates fall, it's going to be hard to sell dead banks. Normally, if we were in a financial crisis, the Fed would have already dropped interest rates, and it'd be very easy to sell assets because there's an embedded profit, right? With commercial real estate, that's not the case because even lower interest rates may not help you. That's the problem.
Because they're floating rate?
No, because it's not an interest rate problem.
Right.
It's a use case problem. It's an empty building where, Elon Musk used to have all of his people in San Francisco, and now they're moving to Texas. Okay. Mm-hmm. And that's an idiosyncratic problem for that building. Has nothing to do with financing.
So if I were to ask you, what are you bullish or bearish on, or neutral on the entire banking sector, weighted by market cap? Every bank that's publicly traded weighted by market cap. Are you that basket? Are you the entire, the whole enchilada? You bullish, bearish, neutral, and why?
I am bullish on the better managed businesses in the sector. I think that the big middle of larger, not as well managed banks are going to get kicked around this year, and you will see lower stock prices. So, even US Bank, which is still absorbing Bank of California, that's a big transaction for them. It'll still take them a couple of years to get back in line in terms of where they want to be with the bank. So not terribly exciting. Wells is shrinking. No reason to be there. PNC, nothing that interesting going on there either. Citi, Jane is cutting costs, trying to figure out what the next step is, right? So if you look at the large caps, not terribly exciting, really. I get a lot more excited about American Express or Ameriprise or some of the other little guys I follow because they build value. If you look at the smaller broker dealers like Stifel and Raymond James, they make a lot of money.
Yeah,
but they're small. You got to take that into consideration when you're looking at the stock.
Right, and Raymond James, I've interviewed some folks there. I think we've even done an interview with
it's a bank.
Raymond James.
It's $100 billion bank.
It's a bank, but most of their revenue is from asset management, not so.
Right. So just like Schwab. Remember you were saying before about Schwab? Same thing. The advisory business is why we're here.
And they make a lot of money when the stock market goes up because they get a percentage of that.
Well, they are, and it's a small, well-run firm. I mean, they don't take a lot of credit risk. Every once in a while, you'll see a little blip out of Raymond James on the credit side. But most of the asset gatherers, as I like to call them, don't take credit risk. That's what's different about Goldman. Goldman loses more money dollar for dollar of assets than JP does. That's crazy, but that's the business they want to be in.
Very interesting. Well, Chris, thank you so much for coming on. We're recording this the morning of July 19th. So all the big banks have already reported, but many regional banks and smaller banks are still reporting. We'll air this on Monday. People can find your work on Twitter at RC Whalen, and your website is rcwhalen.com. Tell us a little bit about this book that you're rewriting, and when is it going to be out?
Well, I have a biography of Stan Middleman coming out in September from Forbes Books, excuse me. And I'm rewriting Inflated, my first book from 2010. And that will be out next year from John Wiley. Having a lot of fun with that. What a time to be rewriting a book about inflation.
Yes.
Well, I get to put some of my good friends in. I'm appalled by the edit I did in 2010. I just apologize to everybody. So don't buy the old book. We're going to burn them all.
Yeah, burn the old book.
Buy the new book is great. I have a forward by David Kotok, which is wonderful.
That's wonderful.
Some fishing pictures.
Yeah, big fan of his. Chris, thanks again, and thanks everyone for watching. Thanks for watching. Remember to check out vaneck.com/moatfg to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.